In 2014, I made a bold move. I split my savings, roughly $100,000, between two very different investment paths. Half went into an S&P 500 index fund. The other half became the down payment on my first rental property. I promised myself I'd track every dollar, every dividend, every rent check, every repair, and every tax return. 10 years later, I've got the full picture. And let me tell you, the results are not what I expected. The starting line, 2014. Let's rewind to 2014. I was 28, had just gotten serious about personal finance, and was tired of hearing conflicting advice. Stocks always outperform in the long run. Real estate builds real wealth through leverage and cash flow. So I decided to test it myself. In 2014, I invested a total of $100,000, splitting it evenly between two assets. $50,000 went into a Vanguard S&P 500 Index Fund, VOO. $50,000 served as the down payment on a $250,000 rental property, financed with an 80% mortgage. Tracking the growth, year-by-year breakdown. Here's how both investments evolved over the decade. I tracked market appreciation, dividends versus rental income, tax implications, maintenance and efforts, and P500. Performance, average annual return, approximately 2%, including dividends, value in 2024, $130, 000 real estate performance, property appreciated approximately 5% annually, value in 2024, $390, 000, mortgage paid down, $70, 000 equity gain, net rental income after expenses, $3, 000 year, total equity plus cash flow, $170, 000 graph, portfolio growth over time. Imagine a line chart here. Blue line, stocks, steady upward curve. Green line, real estate, slower start, then steeper due to leverage and equity buildup. The power of leverage. Real estate's secret weapon? Leverage. With just $50,000, I controlled a $250,000 asset. As the property appreciated, I gained equity not just on my $50K, but on the full value. Quick math. 4.5% annual appreciation on $250K equals $11, 250 year. That's a 22.5% return on my initial $50K before expenses. Compare that to the 10% return from stocks, and you start to see why real estate can be a wealth-building machine. Cash flow versus dividends. Stocks, dividends averaged approximately 2% annually, reinvested automatically, no effort required. Real estate, rent, $1, 800 month, expenses, $1, 550 month, mortgage, taxes, insurance, repairs, net cash flow, $1, 250/month or $3, 000 year. Real estate gave me actual spendable income. Stocks gave me paper gains until I sold. Taxes, the hidden advantage. Stocks, capital gains taxed when sold. Dividends taxed annually. Real estate, depreciation write-offs. Mortgage interest deductions. Deferred capital gains via 1031 exchange. Real estate was a tax shelter. I paid almost no taxes on rental income thanks to depreciation. That's a huge win. Time and effort, passive versus active. Stocks, set it and forget it, zero effort. No emotional roller coaster, unless you check daily. Real estate, tenant calls at 2 a.m., pause, repairs, vacancies, property management, emotional and time investment. Real estate was active. Even with a property manager, I had to make decisions, solve problems, and stay involved. S&P 500 versus real estate performance over 10 years as S&P 500. Delivered an average annual return of about 10.2%, including dividends. By 2024, the investment grew to approximately $130,000. Real estate. The property appreciated at roughly 4.5% annually, reaching a value of around $390,000. Over the decade, I paid down about $70,000 of the mortgage, adding to my equity. Net rental income averaged $3,000 per year, totaling $30,000. Combining equity and cash flow, the real estate investment yielded about $170,000 in total value. Leverage in real estate. Real estate allowed me to control a $250,000 asset with just $50,000 up front. Thanks to leverage. A 4.5% annual appreciation on the full $250,000 property equaled $11,250 per year. That's a 22.5% return on my initial $50,000 investment before accounting for expenses. In contrast, the S&P 500 offered a solid but lower return of around 10% annually without leverage. Cash flow versus dividends. Stocks provided dividends averaging 2% annually. These were automatically reinvested. Required no effort or management. Real estate generated monthly rent of about $1,800. After expenses, mortgage, taxes, insurance, repairs, I netted around $250 per month or $3,000 per year. This was spendable income, unlike stock dividends which were reinvested. Tax implications. Stocks, capital gains were taxed when I sold shares. Dividends were taxed annually. Real estate, I benefited from depreciation write-offs and mortgage interest deductions. Rental income was largely shielded from taxes. I could defer capital gains through a 1031 exchange, making real estate far more tax efficient. Time and effort comparison. Stocks, completely passive. No management required. No emotional stress unless you obsessively check prices. Real estate required active involvement. I dealt with tenant issues, repairs, and property management. Even with help, it demanded time, decision-making, and emotional bandwidth. Final verdict. Wealth built over 10 years. After a decade, stocks grew to about $130,000 with minimal effort and moderate tax efficiency. Real estate reached around $170,000, but required significant effort and offered excellent tax advantages. So while real estate built more wealth, it came at the cost of time and energy. Who should choose what? Stocks are ideal for people seeking passive growth. Those with limited time or interest in managing assets. Investors who value simplicity and liquidity. Real estate suits hands-on investors. Those looking for cash flow and tax benefits. People comfortable with debt and property management. Lessons learned. 1. Leverage is powerful but risky. 2. Real estate requires hustle. 3. Stocks are boring, and that's a good thing. 4. Diversification is key. 5. Tracking your net worth changes everything. What I'd do differently. If I could go back to 2014, I'd still split my money, but maybe not 50/50ths. I'd start with stocks to build a base. Then use the gains to invest in real estate. I'd automate more and stress less. Where I'm headed next. Now that I've seen both sides, I'm doubling down on a hybrid strategy. Index funds for passive growth. Real estate for cash flow and tax benefits, and I'll keep tracking every dollar because the data never lies. Conclusion. The real winner is you. Whether you choose stocks, real estate, or both, the key is to start, track, and learn. Your financial journey is yours to shape, and the tools are out there. So, what's your next move?